so much, Rica, and it's so good to be with you and with all of you. I'm so glad to be a part of this today. I know this is a really hot topic, so give me a moment while I share my screen here. And again, Rica, I may need you to just check on this and make sure that I'm doing this okay. So let me see here. Bear with me, guys. I'm more of a go-to meeting gal, so okay. All right. Okay, so share. Okay, hopefully everyone is seeing that.
It looks great. It looks great.
Perfect, perfect. Okay, so again, we are here to talk about the hot topic of Proposition 19, the good, the bad, and the uncertain. So that's what we're going to kind of dive into today. Just before we get started, just want everyone to know that I tried to find a balance here between getting really way too technical and being maybe not delving into things enough. So I tried to find a middle ground, but hopefully this information is helpful. And at least if everyone can at least learn one or two new things today, I think that'll be a great thing. So before we get started, I just wanted to talk about AdminBooks a little bit. Who is AdminBooks? So we are a California-based accounting firm. We provide tax, bookkeeping, payroll, and advisory services. We are now 100% remote. So pre-COVID-19, we actually did have several members of the team in our Morgan Hill-based office, but we have now moved 100% remote because of COVID. Kind of pushed us over that into the 100% remote team. So we have a team of 19 spread throughout the U.S. And we also were nominated as a top 15 firm of the future a couple of years ago. So something that we're excited about and we like to share. So just a little bit about us. And so wanted to talk about the agenda today. And so we're going to really focus on basically the two big pieces of Prop 19, which has to do, the first one having to do with property tax portability rules for primary residence transfers. The second piece having to do with the intra-family transfers, inheritances of property, and the impact on property tax reassessments. Now, I know Rica had mentioned that there was a session that was done on that piece, I think a couple of weeks ago, but I did kind of want to dive into that too, because I think, frankly, that's actually probably getting, I think, in a way more attention because it kind of surprised some people. Everyone was focused on the expanded portability rules for primary residence transfers, but this was kind of, I think, surprised some people. And so I want to talk about that a little bit too. And then also just wanted to touch on some of the questions, issues, uncertainties related to Prop 19 that are going to require further guidance or legislation. And there's quite a few uncertainties at this point. So I want to talk about that as well. And so kind of to start out, an overview of Proposition 19. So it was passed in November 2020 with the November 3rd election. And again, kind of two different pieces, main pieces here. Personal residence portability expanded, and that's effective for April 1st, as of April 1st of 2021. But then there was also great limitations put on the reassessment exemption for, again, those inheritance situations, those intra-family property transfers. And those limitations are effective starting February 16th of 2021. And just a little bit of a background on this. So prior to Prop 19, only 11 of California's 58 counties had actually opted into property tax portability rules, which allowed a homeowner to sell their property in one county and take their tax assessment with them when they purchased a property in either the same county or one of those other 11 one of the 11 counties that actually opted into those rules. So we were very limited because, all those other counties, they had not opted into anything like that. And so kind of one of the goals with Prop 19 was to expand that to all of California if certain qualifications are met. And so this expanded personal residence property tax portability, that's the good of Prop 19. So what's the bad of Prop 19? So the bad is the limitations on avoiding reassessment on those inheritance situations. So before Proposition 19, parents or grandparents could transfer their primary residence and up to $1 million of other property, so rental property, investment property, to their children or grandchildren after death without triggering a property tax reassessment. And this was regardless of how the heir chose to use the property. They didn't have to use it as a primary residence. And so this has been greatly curtailed with Proposition 19. So that's kind of the bad. And so we're going to talk about those two things today. Okay, and so we'll start out with the personal residence portability. And so who does this apply to? You know, the changes with Proposition 19, who qualifies? So homeowners who are 55 years or older, who have severe disabilities, or who have been impacted by wildfire or natural disaster are going to be able to benefit from these expanded rules. And so anyone who meets one of those qualifications can transfer their tax assessment value up to 3 times in their lifetime in any county in California. And again, this is effective as of April 1st of this year. Now, what is the tax assessment value? So that's your property tax base year value. That's the value on your property tax bill on which property tax is calculated. It's usually the fair market value of the home at the time you bought it, and it's adjusted annually up to the 2% allowed under Proposition 13. And a sidebar here, if in the case of natural disaster, you actually can go more than 3 times in a lifetime. So they actually get a little bit more of a benefit there. And so another thing that kind of came of this is that prior to Proposition 19, even if you were in one of those 11 counties, you had to purchase the new property had to be of equal or lesser value. So now that has also been changed to basically say you can acquire a higher value property and still achieve a blended taxable rate. And what a blended rate basically means is the difference between the value of the original home and the value of the new home. So that increase is added to the transferred assessed value from the old home, and that gets you the new assessed value. So it's still benefiting you, even though you do have to account for that increase in value. So you still get the blended reassessment, which is more favorable. And so I wanted to give a couple of examples here that don't get too technical, hopefully, but just to kind of illustrate this. And so we have kind of basically the same fact patterns in these two examples, except that the value of the home, the new home that is acquired is different. And so in example 1, you know, we have a couple that sells a primary residence with an assessed value of $250,000, and they sell the home for $2 million. They acquire a new home for $1.5 million. So the value of the new home is less than or equal to the relinquished home value. And so the new home retains that $250,000 assessment value. There's no other calculations. That's it. They get that fully transferred. Now, example 2 has again the same facts, except for the fact that the new home is a $3 million home. So they've actually gone up in value from the $2 million that they sold the old home for. So the value of the new home is greater. So the new home is going to receive, again, that blended value. And so it's going to be the $250,000 of the assessed value that's transferred plus the $1 million increase in value, because they went from 2 to 3 million. So that equals a 1.25 million assessed value, blended assessed value in that situation. And so a couple of other kind of details related to the personal residence portability. The replacement property must be acquired within 2 years of the sale of the old property. But actually, the replacement property can be purchased prior to the sale of the old home. So it doesn't have to be that the sale happens first and then the replacement property is acquired. It can actually happen the other way. And also just some definitions. Some of this may seem, you know, pretty obvious, but I kind of like to go into the details of the definitions. So what is a primary residence? Again, seems obvious, but it's a main home that is eligible for either the homeowner's exemption or the disabled exemption. And so one of those needs to have been filed in order for it to qualify for as a primary residence. Victim of wildfire or natural disaster. What does that mean? Well, basically it means it's an owner whose primary residence sustained damage amounting to more than 50% of the original value prior to the natural disaster happening. And a natural disaster is a condition of disaster as declared by the governor. It's generally a disaster caused by conditions such as flood, fire, earthquake, civil disorder, mudslide, or storm is kind of the language they use there. And a wildfire is just any unplanned wildland fire, whether caused by unauthorized human causes, escaped prescribed fire events, that kind of thing. So just some details there. Okay, and so now I want to kind of jump into the other piece of this, the bad. And so this is the related to the inheritances of the property, the intra-family transfer reassessments. And again, this is kind of just a reminder here that, whoops, sorry guys, I jumped there. Okay, just a reminder, so this is effective as of February 16th of this year. Previously, parents or grandparents could transfer their primary residence, again, as a reminder, we already talked about this, but and up to 1 million of other property that's non-personal residence to their children or grandchildren after death without triggering that property tax reassessment. Again, this was regardless of how the heir chose to use the property after they received it. Okay, and so this is, again, been severely limited now with Proposition 19. So again, this is impacting parents or grandparents wanting to pass property to their children or grandchildren upon their death. So with Proposition 19, now the only properties that would even possibly qualify are primary residences. So exemptions for rental and investment property reassessments have been completely eliminated. It can only be a primary residence. And that primary residence, when it transfers to the heir, must be used as a primary residence by the heir as well. So they cannot receive their parents' primary home, for example, and then convert it to a rental and still be able to possibly achieve reassessment exemption. That's not possible any longer. So it must be a primary residence of the parents or grandparents, and it must be continue to be used as a primary residence by the children or grandchildren. And again, this is effective February 16th. But there's another piece to it. Even if the heir uses it as a primary residence, they're only fully exempted from that reassessment if the fair market value upon transfer does not exceed the assessed value by more than $1 million. So if it does exceed that, then they're going to get basically a partial, they're still going to have some reassessment there. They're not going to be able to avoid that. Okay, and basically, and just kind of a side note on this, I think a lot of people have been asking, as I mentioned, are kind of surprised by this. Everyone was talking about the good, the expanded primary residence portability, but this change was included because basically California had to figure out offsetting the loss of revenues from those expanded portability rules for primary residences, and so this is what they did. Okay, and again, and we'll kind of look at this in a second because I have an example, but basically if the fair market value, I mentioned that the fair market value cannot exceed more than 1 million over the assessed value for them to get that exemption from reassessment. If the fair market value does exceed 1 million, is 1 million over 1 million more than the assessed value, the new assessed value will be the fair market value minus $1 million. Is kind of how that works. And again, we'll look at that in an example here. And so what I did with these examples, again, I didn't want to get too technical, but wanted to kind of illustrate, kind of how this works. And what I wanted to do was kind of do a before and after Prop 19 to kind of show you visually how different the results can be. And so kind of the fact pattern here is we have a parent who has a primary residence and a rental property, and they each have an assessed value of $500,000. The fair market value of the residence is $3 million. The fair market value of the rental is $2 million. The property tax liability for each is similar, again, because they have the same assessed value. So in this scenario, we're going to assume that their total annual property taxes combined for the two properties is $12,500, 1.25% for this example. And the parent wants to transfer both properties to the daughter. So example one, we're going to talk about what that looks like pre-Proposition 19, so before February 16th of this year. The parent can transfer, in this scenario, both of those properties without any reassessment. The combined annual property tax would remain at $12,500. And there's no restriction on how the daughter uses the properties. So why is this? Well, the value of the primary residence is irrelevant because prior to Prop 19, there was no value limit. There was no limitation on that primary residence transfer. So there's no change there. And then the assessed value of the rental property, so you remember it's $500,000 for each of them. And so the assessed value of the rental is under 1 million. Remember, it was primary residences and other properties up to $1 million. So because the assessed value of the rental is under 1 million, there's no reassessment. So pretty cool, right? But then we go to example 2 after Proposition 19. And so this is as of February 16th of this year and after. So again, we know that Proposition 19 totally eliminated the reassessment exemption for any non-primary residences, rental properties, investment properties. So we know that rental property is going to be fully reassessed upon transfer. And so that's going to be based on fair market value. So that's $25,000 of annual property tax just for the rental based on the reassessed value. Then for the primary residence, it's either going to be full reassessment or partial reassessment, depending on how the daughter uses the property. So if the daughter moves into the home and uses it as her primary home, she's going to have partial reassessment because, again, that fair market value is over 1 million more than the assessed value. And so the reassessed value would be $2 million because, again, we take the 3 million fair market value, subtract $1 million from that, the reassessed value is 2 million. So right there is 25,000 of annual property tax. If she doesn't use it as a primary home, it's fully reassessed at the fair market value. So the 3 million, which would result in our example of 37,500 of annual property tax. So what's the bottom line here? In pre-Proposition 19, 12,500 for both properties. In post Prop 19, we're looking at anywhere from 50,000 to 62,500 of annual property taxes combined. Huge, huge difference there. So I just kind of wanted to illustrate, I think, why everyone is freaking out about this so much, and kind of how much Proposition 19 changed this. And so one of the things that's kind of being hotly talked about right now is, what are some possible workarounds to this? What can people do? And obviously time is of the essence because February 16th is right around the corner. So there's a few things that have come up that I'm not going to get too technically into, but just want to talk about what they are. So the first one that I think comes up the most is, well, let's just go ahead and gift our properties to our property to our children or grandchildren right now, prior to February 16th. Let's just do it right now so that, we can achieve this, kind of get that full reassessment exemption before the clock runs out, right? Another one that has come up that I think is really, again, very technical, and you would definitely need some guidance on how that would need to be set up, would be the creation of an irrevocable trust that would basically hold the property, and then that's gifted to the children or the child before February 16th of this year. And I'll come back to that in a moment. Also, another thing that has come up is the possibility of setting up business entities to hold properties, which would possibly allow for transfer at death without more than 50% ownership change. Because remember, that's one of the triggers of property tax reassessment is a greater than 50% ownership change. So these are a few of the things that are being thrown around right now, but in moving to the next slide here, I just want to caution everyone that this is something that needs to be carefully assessed and considered. It's really important to obtain, in my recommendation, professional legal and tax advice before proceeding with any of these. And certainly, not trying to go it on their own. You definitely want to have guidance here. There are so many different implications to consider, including potential income tax ramifications. So you want to definitely work with trusted advisors to find the best solution. And just to kind of delve into that a little bit more, one of the things that has come up when you talk about gifting property is the loss of what we call a step up in basis on the property. And what the step up in basis, and I'm sure several of you are familiar with this, is basically in the income tax law. Basically, when an heir receives a property, inherits a property upon death, they receive a step up in basis, which means that the basis, instead of getting the basis, whatever their parents paid for the property, they get the basis step up to whatever the fair market value is upon death. And what that allows for is it allows you to avoid capital gain exposure. So if that child goes and sells the property, they're going to probably have no capital gains and no income tax because the value, if they sell it pretty quickly, the value at death and the sales value is usually pretty much the same. And so this is kind of a big loophole in the tax law. And when a property is gifted prior to death, you're going to lose that in a straight gifting situation, because in a gifting situation, the person receiving it gets the same basis as the person that's giving it to them. So this is kind of a big deal. And what you have to kind of do is weigh that possible loss of that step up in basis with the which do you prefer? You might be getting property tax savings now in exchange for higher income taxes later. Now, it may make sense to go with gifting it and getting the property tax savings, because as you can see from the illustration, that can be very significant. And that might be more worthwhile than, the possible income tax savings down the line. But it is something that you want to think about. Another thing to think about would be the gift taxes, right? Or the implications on that lifetime gift and estate tax limit. There are limitations in terms of not only annually how much you can gift, but over a lifetime. And so even if you are, it's a high, so right now the lifetime gift and estate exclusion is like 11.58 million. It's very high. It actually, or pretty high compared to what it was before. With tax reform a couple of years ago, it basically doubled. And so it's a fairly high exclusion, but anytime that you are exceeding the annual limitations for gifting, which is like 15,000 a year, you're going to eat into that lifetime exclusion. So you want to keep that in mind if you're gifting a property, because you're likely going to eat into that. And that could have implications down the line with your estate, because that's also, it's a combined gift and estate tax limit. So you could expose your estate to significant taxes, which at the federal level, the estate tax is 40%. So pretty significant. So these are the kind of things that you really want to think about, which is again, why I highly encourage, working with professionals, or, for the people that you work with, if they're asking questions, work with those professionals to make sure that you're thinking about all of the different components to it. And, some of the things that, to consider when you're weighing property tax savings versus potential negative income tax implications, would the child or grandchild likely sell the property right away? In which case, avoiding the property tax reassessment really may kind of be a moot point if they're planning to kind of offload it right away. Also, how much has the property increased in value since purchase? I think a lot of the, I think all of in California, most of the time the value has really shot up, right? But that's something to think about, again, in terms of weighing what's more important, the property tax reassessment exemption, and kind of avoiding that, or the again, that step up and avoiding the capital gains down the line. Also, will the parent potentially need the home to pay for future costs like long-term care? Something else to think about. And I did want to also mention one other thing, and I'm going to go back a second on the slide here. So I talked about, and again, I think this is something that's being hotly talked about right now, is the creation of an irrevocable trust. And I talked about the, in a straight gifting situation, losing out on that step up in basis. So the discussion out there right now is that there's a way to, or the consensus is that there is a way to set this trust up and put language into the trust document that would basically allow for you not to lose that step up. Now, this gets very detailed and it's very intricate. You definitely want to probably talk with like an estate or a trust and estate attorney, because there would have to be a very specific way it would need to be set up. And there are so many different ways that it could go wrong. So I just wanted to touch on that because I think a lot of people are thinking about this right now. And if it's something that you're thinking about, it's definitely something you want to jump on very quickly because again, February 16th is right around the corner. And I know, I think that Rica, I think maybe you and I talked about this, that really for all intents and purposes, it's more like February 11th, because I believe that the offices, are going to be closed between, was it the 12th and the 15th? So really the limitation is, it's actually coming sooner than that. The clock is ticking there. So again, just can't reiterate enough that it's really important to carefully consider these options before moving forward with anything, because there are definitely different ramifications there. Okay, and so now I just want to talk a little bit about the uncertainties, because there are a lot of them. And honestly, I probably am not even touching on all of them here in these slides, but just wanted to talk about this and sort of what we're still waiting for more guidance on as of now. So the first one for, the portability rules, and I think this has come up a lot, does one event, either the purchase of the new property or the sale of the old property, or both events need to happen on or after April 1st of 2021 to fit into those new expanded rules? The consensus seems to be right now that one event can happen before April 1st and still qualify as long as the other event happens after that date. That seems to be the consensus, but we don't have 100% verification on that yet. It sounds like we're going to need additional guidance or legislation to clarify that. Another thing that is uncertain right now is, qualifying individuals, they say, can transfer assessed value up to 3 times in a lifetime. But what about transfers that were made under the old rules in one of those 11 counties that allowed it before? Does that, if they've done it before, does that count against that 3 per lifetime limit? Again, we don't know right now, and hopefully that will be clarified. For the intra-family transfers, does the heir need to use the home as a primary residence for a certain period of time? Because remember, the only possible way to get any kind of exemption from the reassessment is that the heir needs to use it as a primary residence. But is there a time frame that they have to meet? If they end up, converting it to, moving out after a period of time and converting it to a rental, what does that do to the assessed value? That's still kind of a question that's up in the air. Also, what about multiple heirs? So, if there is a situation where a property is transferred to, multiple heirs, can one of them live in the property and still qualify for that, that reassessment exemption, or is it all of them? Again, not totally clear. You would kind of think that it would be, that one person living in it would qualify, but it's not clear. And so we will need more guidance on that. Another thing that is unclear is, for portability in the cases of people who have been, had a natural disaster and been impacted by that, does Proposition 19 repeal existing provisions for intercounty assessment values for other types of property affected? So commercial properties, industrial properties, multifamily residential properties. Again, not clear at this point. And also, the new property, kind of the rule that the new property must be acquired within 2 years of the sale of the old property. What about victims of wildfire or natural disaster? As you can, I think all of us can imagine, for homeowners impacted by that, they might have a hard time selling the damaged property within 2 years of acquisition of the replacement property. And so what a lot of people are suggesting is that a constitutional amendment to address that needs to be done to give more time in those kind of situations. And so those are some of the things that, again, are uncertain right now, are unclear, hoping for more guidance very soon. I think that they're going to have to give us more guidance soon on all of this. But these are kind of some of the the questions that are out there a lot that we're hearing right now. And also, I didn't include it in this slide, but I wanted to just let everyone know that there is a really nice informational page on the Board of Equalization website. And Rica, I know we talked about kind of me sharing this PowerPoint afterwards. And so I'll probably incorporate this into it because I don't have a slide on it right now, but I have a link that I will give, and it's Proposition 19 informational page. And they have really nice charts on there that kind of show current law and then Proposition 19, kind of like what I was trying to do when I showed those examples of before and after, but they have nice charts that kind of go into the details that I think are really useful. And so I would highly recommend referencing that page for more information. And I also am hoping that they are continuing to update that. And again, some of these uncertainties that we have at this point, that they will be clarifying those over time. So again, I can share that link when I send that afterwards, Rica, but I don't have it on the slide right now. So I wanted to kind of pause for a second here and respond to any questions. Whoops. Let's see if I'm on the right one here. Okay, yeah, and I think, Rica, you had said that we did have a few questions come up, and I don't know if we have any others that are being entered in the chat box or anything like that, but Rica, did you want to review those questions?
Yes. We can start with the questions that came in earlier, and then if anybody has any other questions, they can type into the chat. But because I'm the host, now I have a ton of questions. Historically, Sabrina, those uncertainties, how long does it take to flesh those out? Because we'll have to have you back again once those are fleshed out so we have a better understanding. But historically, do you have an idea of time frame when those get fleshed out?
Well, I think they're going to be pressured to do it as soon as possible, because obviously, people, we have these dates that we're talking about where people are, trying to plan around and take action. And it's kind of hard to do that when there's so many uncertainties. So I don't have a specific time frame, but I think that they're going to be pressured to clarify a lot of this very soon. Because again, February 16th is right around the corner. April 1st is right around the corner. So I'm hoping within the next several weeks, we'll see more guidance, more legislation, possibly to clarify this. But unfortunately, I don't have an estimated time, but they're under a lot of pressure right now to clarify these things.
Well, I'm going to put you on the spot, and I'm going to ask that you come back and join us when that happens, so you can give us some clarity around that.
I'd love to.
Okay.
Absolutely. I'd love to. Yeah. Because there's a lot
Okay.
that we still don't know. Yeah.
Right. Okay. So now the questions, can I carry my tax basis to a new home in Contra Costa County if I make an offer before April 1st, but escrow doesn't close until after April 1st or later?
Yeah. So my take on that is, as long as the transaction actually happens after April 1st, I think that you're okay. Even if the
close of
offer was,
escrow, as long as the close of escrow
sorry,
is after.
yep, as long as the close happens after, I think that you're
Okay.
okay. I think the offer happening before is kind of a moot point. It's whenever the closing actually happens.
Okay, fantastic. Selling a current home and moving to a new one in a different county. What happens to tax basis and when residence passes to an heir?
Yeah, so this goes back to kind of what we were talking about with the changes with those intra-family transfers, right? You're going to have, if you transfer it to an heir and they don't use it as a primary residence, there's no exemption from reassessment. It will be fully reassessed at that higher value. If it's used as a primary residence by the heir, then there's going to be at least partial reassessment, if not, or partial exemption or full exemption from reassessment, depending on, as I mentioned, the value. Because remember, with Prop 19, there's now that in order to get the full exemption from reassessment, the fair market value cannot exceed more than 1 million over the assessed value. So it's going to depend on, again, those two factors of how is the heir using the property when they receive it, and what is the value compared to the assessed value. What is the fair market value compared to the assessed value?
Okay. What are the fact patterns where a property owner would want to gift their residence to their children now or before February 16th due to Prop 19?
Yeah. So, and I think we kind of talked about this a little bit,
Yes.
but for the gifting, again, before, because that would be kind of the mindset is you would want to gift before February 16th in order to take advantage of the current rules. But again, as we talked about, you have to think about that loss of the step up in basis.
Right.
And again, that's why I would encourage anyone who's thinking about doing that to, consult with professionals on, and I mentioned, the trust piece of it, because that might be a way to gift it, but get around that loss of the step up in basis. So, yeah, gifting before February 16th, you would be able to take advantage of the current law, but you may be dealing with that loss of the step up and have high, income tax ramifications later. So I'm not sure if I'm answering that completely, but
and whoever asked that question, if you want to chime in too, I think what Sabrina, you've given us a lot to think about, and a lot to consider. And those of you who are considering an irrevocable trust and need a recommendation, we have great trust and estate planning attorneys that we work with that we can help recommend to you as well. So moving on, has a state board, I think you might have already answered this too. Has a state board of equalization determined if you sold your original property prior to April 1st and bought the replacement property after this date, will the transfer of base value be eligible under Prop 19 or Prop 90?
Yeah, and that's still kind of what we don't know. Exactly. Again, the consensus seems to be that if one event happens before and one event happens after, that it will qualify under the Prop 19 new rules, but it's not clear yet. So this is one of the things that, and I don't know about the rest of you, but I want confirmation. I don't, I don't like to, kind of guess based on what the consensus is out there, but the thought process is that will qualify under Prop 19, but we really need further clarity from Board of Equalization.
Okay, we can't wait to have you back, Sabrina. So Robin wrote in the chat wildfire damage. Robin, do you want to take yourself off mute? I'm not sure what you're asking.
Okay, can you hear me?
Yes,
Yes.
Can you hear me? Okay,
yes.
now the fire damage, my significant other's whole house burned to the ground. So he would definitely qualify for the wildfire damage. My house survived the fire, but all my outbuildings, I lost everything on the property except my home. Would I still qualify for the wildfire damage because my home still stood?
No, that's a great question. I think it
That's
would go, so Robin, I think what it would go back to is that whole 50% of the value. So remember that the language there is that the damage has to be, the value of the damage, it has to be at least 50% of what the original value was. So even though, you know, in the case you're talking about, you know, so the primary residence is still standing, but outbuildings were lost. When you look at the value of the property as a whole, those outbuildings may very well account for 50% of the value, along with, you know, if there was some kind of damage to the primary home itself.
Yes.
So
Yes.
I think it depends on that value, but absolutely, I mean, you know, depending on, again, the value that's placed on those outbuildings, it definitely could. It really comes down to that.
Yeah, because like the insurance, when I filed my claim, it was, I received from my insurance company more than half of the property value because of all the stuff and all of the outbuildings that were lost.
Yeah, I mean, I absolutely think as long as you're hitting, yeah, sorry, go ahead.
So the insurance company at that point considered it half of the, more than half of the property value because of all the damage. It's 20 acres and everything but my home was gone.
Yeah.
I'm so sorry.
That's terrible. I'm so sorry. I'm so sorry that you had to deal with that. And I would say, you know, if the insurance company basically kind of already made that determination, then I do think it would qualify because it's more than that 50%.
Okay,
Would she
thank you.
have to just show what the insurance company valued it at? Would that be proof enough?
You know, that's a good question. I don't know if that would be enough in and of itself. You know, I'm not sure if there would need to be some kind of, you know, appraisal situation, you know, where someone comes in and looks at it, an outside third party, possibly. That's a good question. And Robin, I'd be happy to check into that more and give you guidance after the meeting, if that would be helpful.
Okay, great. Thank you. One more quick question. Now, we're talking about primary residences and then rental property. If it was commercial property, that doesn't count at all in this. It's just automatically going to be reassessed, correct?
Correct. That's correct. Yep. So that expanded portability is primary residences, not commercial or other types of rentals and that kind of thing.
Okay. All right. Thank you.
Okay.
Absolutely. My pleasure.
We have a few more questions.
Okay.
What is the 50% ownership option? This was the third bullet point on the option slide.
Yeah. So what that relates to is basically, and again, I don't try not to get too technical with it because there's a lot of, you know, intricacies there, but basically what it has to do with is creating a business entity or business entities to hold properties. And then basically you would structure it so that, you know, kind of multi-owner situation so that when the parents do pass away, there wouldn't be it wouldn't be an over 50% change in ownership because there's already some ownership. The children already have some ownership, if that makes sense. And so and again, it gets kind of intricate and you'd have to get, you know, kind of assistance in getting that set up properly. But the whole goal behind that is if you're able to avoid you know, more than 50% transfer of ownership, you know, the rules state that, you know, because again, when you're over 50% change in ownership, that's an automatic trigger of reassessment. And so the thought process behind that is if we can keep it under 50% transfer, then you're out of that and you don't have to reassess. Again, pretty intricate stuff there. So you definitely want to get some guidance in get how that would need to be set up.
Okay. Follow-up question, or I don't know if it's follow-up. There's two more questions. My parents have a rental they use to pay for their assisted living facility. Is a $1 million exemption eliminated?
Can you read that once more, Rica? Sorry.
Sure. My parents have a rental used to pay for their assisted living facility. is the $1 million exemption eliminated.
Hey, keep reading.
What was that?
What was that? Sorry, I didn't know if someone was trying to chime in. Well, I'm sure, so which, the $1 million, are we talking about, so the $1 million, I just want to make sure, and whoever asked that can chime in. Are you talking about the million that, so not being able to exceed, over 1 million over the assessed value? Is that what we're talking about? Or are we talking about something else?
Yeah, no, that's the million.
Okay. Yeah,
Okay.
I don't believe so. Now that is something I can double check on because I would want to check on that, I think. And that's something I can look into to see if there's anything. As far as I know, no, it wouldn't be. But I can look into that further if you'd like. And I'd be happy to follow up after the fact if that would be helpful.
Yeah, basically the scenario is right now, my parents used to live in that home and they pretty much had to move out to an assisted living place. And then right now they use that as a rental income to subsidize their, so once they pass, if their home in San Francisco is worth 1.8 million, let's just say, do we still have that million as a kind of like a exemption and then get reassessed for just the 800,000?
Yeah, because I see what you're saying, because it's kind of a gray area because they had to move out to go into assisted living. Is that kind of what you're going with it? It's kind of a gray area because they were basically forced to. I mean, the fact that and you said it's being used as a rental now, is that what you said?
Yes.
Okay. Yeah, I mean, I think, again, I can look into this to say for sure, but I think just based on the black and white of it, I don't think it's going to qualify because it's technically right now no longer a primary residence. And so that's where I think that you might run into a roadblock with that. But I can look into that just to kind of to verify for sure. But just based on what I know right now, it's probably not going to, you're not going to get that million because of the fact that it's being currently used as a rental, if that makes sense.
Okay. And then just as a follow-up to my last question, I mean, is this pretty much impact just people with Prop 13 protection, tax protection, where the assessed value is like only $2,000-$3,000, which doesn't make sense. Like, for example, if I purchase a home just within the last 10 years, it was assessed at market value, and the only thing they have, or we have as protection, is it can't go up more than 2% per year. And if one day I want my kids to have this house, basically, will they fall under the same pressure as we with our parents now? Where if our house goes up to $2 million in Foster City, they'll get reassessed at the fair market value versus what we're paying under our protection of 2% per year.
Well, yeah, because so if you qualify, well, let me think about this. So, well, I guess, can you restate what your question is? I'm sorry, sir. Can you restate that one more time?
Oh, I'm just asking basically, will it affect my kids versus me being affected by my parents? Because my parents has a very low property tax right now. And once they pass, it's going to go up to fair market value, be assessed. Then for me, if I want my kids to have some kind of protection, maybe they won't.
Yeah, I mean, with these changes as of right now, and again, it depends. There's the fact pattern of, when you pass it along, if you pass it along to them down the line upon death, how are they going to use it? Now, we don't know what's going to happen. Things could change, right? Things do change a lot. And so, there could be changes within the law before that time comes. But if things stay as they are right now, that reassessment is likely to happen, again, barring, because I think in a lot of cases, especially when we're talking about California, that whole $1 million, not wanting to exceed the fair market value to exceed $1 million over the assessed value, I think in a lot of cases it will exceed that, right? And so I do think that unless something changes, that's something that they are going to have to deal with, depending on the fact patterns specifically to your situation.
Okay.
Does that help?
I think just like you said, I'm sorry. I think just like you said too, Sabrina, I mean, that there could be another proposition that passes between now and then that changes everything. So
Yes, absolutely. Things could change, things do change often. So, but I think as of based on what we know right now, they are likely to be impacted by that, regardless, one way or the other, even if they are using it as a primary, just because of that 1 million kind of limitation there. So.
Okay, thank you.
okay, so we have another question from Robin. So Robin, I'm going to ask you to unmute because she put joint tenancy. So if you can please expand on that question.
Yes. Now you said that if I have my home in joint tenancy with my daughter already, it's been in place for a few years now, so that she would only have to inherit half of the value because she is already owner of half. Would half of it have to be reassessed, or would she just not have to have it reassessed at all because she already is a half owner?
Yeah, that's a good question. I think I would lean towards it because basically in a joint tenancy situation, yeah, her name's already on it. So my thought process would be that reassessment would not need to happen. Now, again, this also has the effect of, that whole issue with the step up in basis, which I talked about a little bit. But in terms of just talking about the property tax component of it, I'm thinking no, because she's already in a joint tenancy situation. She's kind of already co-owner. So I'm thinking not. Now, Robin, the question of, would 50% of it need to be, that's a good question. I can double check that. But based on what I know about joint tenancy, I would kind of think, again, she's already on the deed. She's already part owner. So I'm kind of thinking that it wouldn't need to be even on 50%.
Yeah, typically on joint tenancy, if somebody passes, it just goes to the other owner.
Exactly.
Typically. But I never thought of that, Robin. You're thinking of all kinds of creative ways to get beyond this. That's amazing.
Yeah, you're thinking great questions, Robin.
Yes.
Definitely. And I can double check that. But Rica, I'm with you. I mean, it seems like just what I know about that, that it would just transfer to her, and she's already on there. So she's already co-owner. So
then you don't have to worry about reassessment. You don't have to worry about step up basis. You don't have to worry about any of that.
That's what I was hoping for. But even before Prop 19, I was trying to think of how she wouldn't have to pay inheritance tax on the whole thing. She would technically, even federally, will only have to pay for parts.
You're a smart mama, Robin. Okay, does anybody have any other questions for Sabrina? This has been so enlightening. Thank you, Sabrina.
Well, my pleasure. I only wish I had more details on the uncertain, because that's hard.
We're going to hold you.
We don't know.
Yes, we're going to hold you to coming back and sharing with us once there's clarity around all those things.
Absolutely. I'd be happy to. And hopefully sooner rather than later, right?
Yes, definitely.
So one last question on the 50% ownership. Are you certain that it won't trigger a reassessment if it's less than 50% change?
That's the understanding based on the way the rules are written for, like, kind of the rules have been like that when there's less than 50% change, it doesn't trigger a reassessment. That's based on existing law. So that's our understanding as of right now. And again, just to be very, very clear, there's kind of been this mad scramble in the last couple of months, right? Or the last, however long it's been, month and a half, almost 2 months, I guess, right? That, of how we can work around this. And so this is kind of one of the ideas that's being thrown out there. Again, I would definitely get some professional guidance on that before, kind of committing to any of those. Right. But that's the idea behind that, is that you can structure, again, kind of create business entities and, put the properties within them, and then create and I don't know if it would be a situation where over time, some of the ownership gets gifted to the kids, and then it would be a situation where upon death, they already have part ownership. And so it's not going to be more than a 50% change, if that makes sense. So that's the idea behind it. But I would definitely, talk to a professional about that before, committing to anything like that. But that's the thought process, because that has been the case. Again, previous was that if you were under the 50% ownership change, it would not automatically trigger reassessment.
I have a quick question.
Mhm.
I'm not sure if this is in with along with all of this, but my mom owns a house in San Mateo, and she had been disabled for, I don't know, 10 years before she went on Social Security and became a senior. But her taxes seem to go up every year still. How does that, is there something she should be doing to not have that happen?
Well, I think that, I mean, obviously the property taxes generally do go up a little bit every year because there is that, under the Prop 13, there's that increase that can happen to the assessed value every year. So I don't know that there's any way to completely get around that. But again, because she is disabled, if she's fits into that qualification of severely disabled, she would be able to, again, have that portability and be able to transfer the current assessed value of her home to another home if she decided to move. But as far as the annual increases, I think that that's, property taxes do tend to go to inch up a little bit every year because that assessed value inches up every year. And so I don't know if there's a way to get around that.
Okay. She bought the home in, I think, 78. So it was just after Prop 13.
Got it. Yeah. Yeah. And so she obviously it's trickled up every year again, that, that up to 2% that they can do. And so, yeah, that it makes sense that it goes up a bit every year. But, and again, I don't know that there's really any way to get around that, the annual increases.
Mhm. I have a separate question too. Sorry, I don't know if I'm taking up too much time, but
No,
we have a house that we bought in Santa Cruz, and from last year to this year, they assessed it $100,000 more than what we bought it for. And our taxes have increased like over $1,000. Does that seem like something I should look into, or?
let me ask you this. Did you have any significant changes to the property? Did you do like significant improvements on the property or anything like that?
We're actually in process of doing that, but we haven't done anything. I mean, nothing is recorded yet. We are increasing the size of the property, but it's not recorded. It just went, we bought it basically for $650, and now they're assessing it already for $750.
That's interesting. I would look into that. If it were my situation, I would double check, because again, if you had already done improvements on it and that was already recorded, and then it would make sense. I mean, that's where we tend to see big jumps like that from one year to the next, when there's significant changes to the property. But if you haven't done that yet, that seems odd to me. I don't know, Rica, if you have any
I
thoughts on that.
I
but-
totally agree with you. If you haven't done any improvements yet and your tax, they assessed you higher, I would
Mhm.
definitely question that.
Well, relative to the neighborhood, it should be at a higher value. We got it at a really good price, but we've done nothing to have a reason for them to change that. And so we don't understand how our taxes went from, like, I don't know, 7,000 to 9,000 this year.
Yeah,
I think it's worth questioning.
yeah, I would check it, even if they have some legitimate reasoning behind it. I don't know if it's something where they were trying to get it in line more with, because like you said, you got a good deal on it. So if they were
Mhm.
trying to get it more in line with actually fair market value, that's the only thing I can really think of. But I agree. I think it's worth asking about to see, because maybe there is an error.
Yeah. Who do I check with? Just calling the county? I mean, I don't know.
Yeah, like the assessor. Yeah, the assessors. That's where I would start. Yeah, I mean that's the first place, the county assessor's office. I would call and ask them.
So they have the ability to actually assess it that much different and actually add that. I mean, I thought the 2% was the code.
The 2% is, and so again, I don't know if it's that's again why I would say I would question it. Now again, I don't know if there's a loophole within there somewhere where, again, because you got it at such a good deal, they're doing a comparison between fair market value and, kind of your cost. But the 2% is that's kind of within the law. So I do think it's, for that reason, worth asking about.
Okay. Thank you. I appreciate that.
Absolutely.
Okay, everybody, it is 1 o'clock and I always want to be respectful of everyone's time. So Sabrina, I think you're going to put your information on the screen. And of course, I
Yes.
have her information. So if you guys need anything, I'll also make sure to get the link to the Board of Equalization.
Yeah, and I
I'll let
have
Sabrina wrap it up.
Yep, and I just have a couple of slides here. I do wanted to mention, and this isn't on there, but if anyone is interested, oh, actually, I think it is on there. We have our Get Acquainted. If anyone is interested in exploring AdminBooks services more, we do offer a complimentary kind of get to know you meeting. It's called our Get Acquainted meeting. Mention Rica's name, and you know, we can coordinate that with you. We do also offer a newsletter with a lot of educational articles. We have a Facebook page with you know, kind of up to date, interesting information for you. And yes, I'll put this on the screen here, our contact information. Again, Rica, I'm happy to send a copy of the PowerPoint if you'd like to kind of share that with everyone. If anyone's interested, I'm happy to do that. But yes, please contact us. Phone numbers there. We have our email address and so forth, our website. So if you're interested, please reach out.
Yes, absolutely. And if you guys don't get this information, don't worry. I'm going to be sending a follow-up email. And for those of you who are interested in either the recording or the slides, just respond to my email. I'm happy to send that to you, along with the link that Sabrina is going to offer for the Board of Equalization. And I'll make sure once there's some more clarity around that Sabrina will come back and share that with all of us. So thank you all so very much. It was wonderful to see you guys. Next time, I hope you all turn your videos on.
Thank you so much, everyone.
Okay, thanks everyone.
Have a great day.
Thank you.
Have a good one.
Bye-bye.
Bye.
Thank you.
Thank you, Rita.